Welcome. In this learning, we are talking about risk and reward of call option buyer. So we will go through two stages. First, we will create a worksheet in Microsoft Excel, and we will also create a risk reward graph when you are a call option buyer. So let us start this scenario. So the scenario is that you are here a call option buyer, and suppose you have purchased call options. So you have purchased one contract of coming August $65 call option, and you have paid a premium of 2.50. Now we have to consider every particular in this case, and we have to see that okay, what is the risk or reward for you as a call option buyer. So when you are a call option buyer, so first of all, we have to see what is your outlook. Remember, in one of the previous learnings, we have talked about that you are either bearish or you are bullish. So if you are a call option buyer, your outlook is bullish. So we are in this situation where you have purchased call option and your outlook is bullish, which means that you think that the price of this share would go up. And since you were bullish, so you thought, okay, let us purchase call option, and then you have to pay the premium. So what is the premium paid in this question? The premium that you pay is $2.50 per share, and this is denoted by CO in this example. So by paying this option premium, what rights you have created for yourself? You have created for yourself right to buy the shares at the strike price, and the strike price in this case is $65. So this is the right that you have created for yourself. So what is your obligation when you buy a call option contract? So call option contract is the only obligation or responsibility that you have, or cost you have, is that you have paid the option premium. Right? And by paying option premium, you have acquired the right to purchase call option on expiration. So whenever you buy a call option, just pay attention to exercise price. In this case, we are assuming that you have purchased call option and the exercise price or the strike price is $65 per share. Now, why this is important, why we need to pay attention to exercise price? Because on expiration, if the price is more than this means if the price is more than the market price of the share is more than the exercise price, right, then you will gain, right? Because you are bullish, you thought the price would rise, so you purchased call option, you purchased the right to purchase it at $65, and suppose price goes to $70, then this is definitely a positive situation for you. And in this learning, our whole focus is first to create a worksheet, the risk reward worksheet for a call option buyer, and then also draw a graph in Microsoft Excel. So what is expected range of variation that we are considering here, and range of market price that is to be considered for generating this risk reward worksheet. So that is what we are outlining here, and the market price, the range of the market price of this share, we are taking this way. We are taking it from 50, 55, 60, 65, 67.50, 70, 75, 80 and 85. So in this range, we will calculate the risk and reward for call option buyer. Now what is the payoff to you as a call option buyer? This is calculated through this formula. So maximum of 0, that is ST is market price on expiration, minus X, which is the exercise price. So ST minus X and 0 will be compared, and maximum of these two will become payoff to the call option buyer. But remember, call option buyer has also paid what is known as option premium. So this option premium has to be deducted to compute the profit for call option buyer. So profit for call option buyer is this payoff minus the option premium which is paid to the call option seller. So these formulas have been used to calculate the payoff as well as profit per share to call option buyer. And when we are talking of total profits, right? So before we calculate total profits, we always pay attention to how many option contracts were made. So in this example, we are assuming that only one option contract was made. So therefore 100 shares are involved. And finally, we will also calculate the total profit to the call option buyer. And this total profit is profit per share times the number of shares that this call option buyer has traded. So if one contract has been made, then definitely 100 shares are traded. And finally, we will also consider the situation that what is profit or loss to you if you had decided to purchase the shares at $65 each instead of purchasing the call option. So what would have been your profit or loss in that situation? So in this Excel sheet, so we have taken certain rows. So first row has the market price at expiration. This call option that you purchased, its strike price is 65, right? And in future is uncertain. The things can go in your favor. Since you are bullish, you will be gaining when the price goes above $65. So it goes to 70, 75, 85 or something which is above 65, right? And then things can go against you if you are a call option buyer if the price falls, because you are bullish and you will lose when the price goes down. And strike price of course is 65. And then according to this formula that we have used here, which was shown previously in the slide, using that we have calculated the payoff to the call option buyer under various situations, under various price ranges. So we computed it, and then this is the payoff to this call option buyer. And option premium is definitely $2.50 per share. So if we deduct from payoff this option premium, then this gives us a profit per share to the call option buyer. And since the number of shares traded are 100, because one contract is only there, one option contract is made, therefore this profit per share is to be multiplied with the number of shares, which is 100. So we will get this total profit, and we have calculated total profit to the call option buyer in various situations. And this total profit as well as this market price we have plotted here on this graph. So on this graph we have plotted on vertical axis the total profit or loss to the call option buyer, and on horizontal axis the market price of the share on expiration. And this is the total profit line that goes. So we see that when I hover over here, and it shows that the break-even point is 67.50. So if on expiration the price of the share, the market price of share is $67.50 per share, then this call option buyer is at no profit, no loss. And it makes sense also. You made the contract to purchase it at 65, exercise price was 65, 2.50 was the premium that you have paid. So the break even for you would be 67.50. So this is the break even point. And any price, like on expiration, if price is below 67.50, you will make losses, and you will make profit as a call option buyer if price is above 67.50. So this is that tells how much profit you will make under various situation. Various situation just means the price may be 50 on expiration, or 65 on expiration, or 67.50 on expiration. In these situations, you are not making any profit at 67.50. You are making no profit, no loss, but anything below that you are making losses, and anything above that you are making profit. So if rather than purchasing the call option, you had purchased the stock itself at $65, then this is your risk return graph, right? So at 65, if on this date in August, $65 is the price, then definitely you purchased it at 65. You are selling at 65, ignoring the trading cost. You are at no profit, no loss. But if in this future time the price goes below 65, you will be at loss, and if it goes above 65, you will be at profit, ignoring of course the trading costs, the commission paid to purchase and sell the cost. So this is how risk and reward worksheet you can prepare for yourself, and graph you can make for yourself if you are a call option buyer.